everyone, this is Rob Roy, and welcome to the Elliott Wave Options S&P 500 U.S. market update. A lot more to talk about regarding the Federal Reserve's unprecedented announcements on Friday, so let's get to the charts. Before we get to the charts, I just want to say that y'all did a great job on the Chuck Norris one-liners. If you're not sure what I'm talking about, take a look at our last video. We're giving away a free 12-month subscription to our full alert service, both the impulse and volatility portfolios. To enter, just hit the subscribe button, post your best Chuck Norris one-liner, and we'll announce the winner at the close of trade on Monday. Hopefully that brought a little levity to your holiday weekend. It sure did for us in reading them. He had some great choices. Taking a look at the markets, the beginning of the week is going to tell a lot. At the time of this recording, the futures are down 40, which is pretty much where they opened. They opened down 40 and have just flatlined ever since. As a reminder, we had this big move down, which was a completed zigzag pattern with an extended C wave. Then we had the B corrective wave, which was also a completed zigzag. And now we sit here in this much larger zigzag at that 50% corrective level. Now the key will be, do we hold at the 50% level, or do we move up to this 61.8% level, which is well within Elliott Wave zigzag rules. In fact, the 61.8% fib level is one of my favorite fib levels because it's a very strong point of support and resistance. In the last recording, we got a lot of questions and comments regarding our strangles that we talked about and the patterns that we utilize to enter those, which are known as triangles. So I thought we'd do a little education on exactly what the triangle pattern is. And triangles in general terms are breakout patterns. It's a stock that's been trending, but it's no longer trending. It's now consolidating. So once we identify the consolidation phase, we look for the width from the mouth down to the point, and the further we go into the point, the greater the expected breakout. It's like compressing a spring with your fingers. The further you press it down, when you release it, the more it jumps. And these chart patterns do the exact same thing. Triangles give us also a decent idea of about how far that breakout move is going to be by measuring the width of the mouth of the triangle. We don't know what direction it's going to move. We just know it's going to break out. That's the reason that we use the strangles. You don't know which way they're going. They are Elliott Wave corrective patterns. Remember, corrective patterns are flats, zigzags, and triangles. So triangles count in that. So we'll talk more about that next time we talk a little bit more about Elliott Wave. But looking at these patterns, we have the symmetrical triangle, which is basically a set of lower highs and higher lows. We also have an ascending triangle, which is a set of similar highs with higher lows, and then a descending triangle, which is lower highs and similar lows. And these triangles are all over the place in the financials right now, so I thought I would show those to you. So we look at the 20-year Treasury here as evidenced by TBT. And you can see that we have the Elliott Wave pattern to the downside. But remember the rules. When you have one of these corrective patterns, and a triangle is a corrective pattern, doesn't have to be a triangle though. Flat zigzags or triangles are all corrective patterns. Elliott himself said the corrective patterns supersede the larger Elliott Wave pattern. So we turn the Elliott Wave off, and you can see clearly we have this descending triangle very similar to what we had in oil recently. Then we move to the 10-year bond. Look at that for an Elliott Wave pattern. The wave 4 right at the 38.2% fib level. Just classic stuff. But again, you can see the triangle. So turn the Elliott Wave off, and there's your symmetrical triangle in the 10-year bond, indicating that it's going to make a pretty decent move in the not too distant future as well. And then we look at the dollar. Remember the dollar? We talked about this where we had this big mono wave A impulse and then a mono corrective level, and now you can see we have this complex C wave that's being formed as this triangle creates a pretty decent breakout potential out of the dollar. So that's why I was saying, yikes, what's going to happen with all this volatility in the financials? One other pattern to take a look at, gold. There's your ascending triangle. I told you we had them all covered. Look at this for Elliott Wave technical analysis. We had the wave 5 that completed where you're supposed to go, back to the previous 4, which it did, and then following a 5-wave pattern, you likely go into a corrective pattern, which it did with this large ascending triangle. Now, there was some discussion about manipulated markets after the last recording. Well, there's nothing more manipulated than gold because the Federal Reserve shorts gold. It's the only reason gold isn't up at $5,000 an ounce like it should be. So when we talk about the Federal Reserve and their new program of injecting $2.3 trillion more, that's an expansion of their balance sheet. They always talk about expanding or contracting their balance sheet. They really contracted, but they did announce that they're going to slow down their purchase of treasuries right now from $50 billion a day down to $30 billion a day, and they're going to reduce their purchase of mortgage-backed securities from $30 billion a day to $15 billion a day of liquidity that they're injecting. And if you're not sure how this works, the reason they talk about their balance sheet is that the Federal Reserve doesn't actually physically buy bonds and treasuries. That's how they inject liquidity, but it's a journal entry on their balance sheet. They then authorize the Treasury Department to print this paper right here, because it's not a dollar. Look across the top of it. Pull one out of your pocket or your purse. What does it say across the top? It says Federal Reserve Note. What's a note? It's a debt. It's a promise to pay. Every time the Federal Reserve does this, we're going further into debt to the Federal Reserve. Because remember, they're independent. They're not part of the U.S. government. How do we get out of this debt? I've showed you the debt clock before. I don't see how we can ever get out of this amount of debt that we have without going to negative rates. But that's something the Federal Reserve said they would never do. They said they would never go to negative rates. But they also said they never buy high-yield bonds. So who knows what's going to happen. Anyway, hope you found that informative. Hope you had a great holiday weekend, got the chance to spend some quality time with your family, and we look forward to talking to you again soon. Beginning of the week's going to be interesting. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.